the monthly cash flow starts out at positive $700 a month. So in my mind, when I'm looking to avoid risk, that's kind of the first place I start, because, if I've got other people paying the mortgage, that's really how I hedge a lot of risk.
Yep.
And that gives me wiggle room. That's $700 a month. If I have a vacancy, if I have a repair, whatever, that allows me, I'm positive. So even if maybe I have one vacancy, I'm only coming up with a couple $100 a month rather than, a whole mortgage.
Drake's so right. And listen to the language he's using. He's looked at things enough, and he's saying, well, it cash flows a little bit. And if there's a rainy day, I can afford some maintenance. And if I have one of 2 units vacant, I'm only going to have to supplement the payment this much. Translating that to like a lot of first-time investors I've seen, or perhaps what is taught at a lot of seminars, is, well, your deal one should be an absolute home run, and if it doesn't cash flow X amount of dollars, then go on to the next. And again, back to that paralysis by analysis, you can go a year or 2 or 3 trying to get in to your first investment, learning a decade later that the number one factor of your good return was just getting into it early and quick.
Hello, and welcome to the Infinite Financial Freedom podcast and live stream. Today's episode is going to be a little bit different because it's going to be really graphic and educational heavy. So if you're listening to this in the podcast, we're going to do our absolute best to kind of summarize the things that we're walking you through here, but it might be a best practice just to go over to the YouTube channel and watch the recording on video, since it's going to be such a graphic heavy podcast today. So it's really exciting for me to be here because I get to be joined today by 2 of my favorite best friends and real estate investor partners. So I'm here with Jake Breen, MBA and real estate broker, investor, advisor, and a really great friend of mine who's going to give a very interesting perspective from the realtor and investor standpoint. And also Drake Bloebaum, who is a investor partner of mine and longtime friend, and he owns apartment buildings and all kinds of stuff all over the country. So it's going to be fun to dive into these things. And really the topic today is how to maximize profits. There's a saying that profits are in the purchase, and at the same time, avoid risk. So we want to avoid risk. We want to maximize return, and we want to make sure that we're really teaching an intentional way to go about acquiring rental properties. So with that, Jake, Drake, welcome, guys. Super glad to have you here today.
Excited to be here, man.
Thanks for having us.
Yeah, my pleasure. And Drake is, we really ought to thank you, man, because you're taking time out from a sick powder day. I can actually see the snow coming down behind you to join us on a podcast. So excited to have you, and hopefully we get you out here soon enough to get some pow.
Thanks, man. Appreciate it.
All right,
pleasure.
Team, so what we thought we would do is walk through our 3-step process to avoid risk and to maximize returns in real estate. And, as Drake and Jake and I come up with properties that we analyze, we always go straight to the numbers. We're always saying, okay, great. The picture looks good. Let's jump right into the numbers. So I thought what we would do is show off 2 different processes that we use to evaluate the numbers. One for a residential property, and then I'll walk through that. Drake will interject and give his thoughts, and then we'll turn it over to Jake, and he'll walk us through how we do the exact same process with a commercial property, which is a little more sophisticated, and Jake will walk us through that. Guys, before we jump into that, is there anything else that you want to say to kick us off here or preface?
Yeah, I think it's important to add one thing. And I personally, when I listen to material online or podcasts, advice and opinion are one thing, which I love to listen to other people's advice and opinions. But then for me, it's most helpful to hear real world, tangible examples. And so the 2 deals we're going to walk through today are, one's an actual transaction we already consummated recently this past November. And another one's a deal that we are transacting right now, live in this market. So I think that's really important to tune into and know before we dive into these numbers, these are not hypothetical transactions.
Great point. Yeah, there's a difference, as you said in our prep call, between kind of theory and practicality. And so we're going to get into a real practical deal analysis here. All right. Well, Drake, I'm going to kick off. This is your favorite spreadsheet. And again, team, I'll try to articulate what we're seeing on the screen as much as we can to make sure that this is valuable from a podcast perspective. But this is a calculator that's available on calculator.net, and it's their rental property calculator. And Drake and I have found this calculator and have helped a lot of clients go through it. We analyze our own deals on it. So this is a duplex. It's a 2-unit property. The purchase price is approximately $400,000. And this investor that we're working with on this is actually going to get 100% financing for this property because it was really kind of a great deal. And the property needs about $250,000 in renovations. So we think they'll be in it right around $650,000, and a very, very, very conservative after repairs value of $700,000. So you can see how this works. You just kind of plop your way through here. Purchase price, if you're going to put a down payment, what kind of rate we would expect the mortgage to be when the renovations are all done, how long of a loan it is, closing costs. We can put in real property taxes. We show that we have an annual estimated increase of 3%. Same thing for insurance. Same thing for maintenance. We're going to guess there's a couple $100 a month for maintenance. Same thing. Those will increase with inflation over time, estimated at 3%. Other costs. This could be odds and ends, banking, legal fees, maybe once every 10 years, you got to pay for an eviction or just little ancillary costs that we want to include in the analysis. And then we'll throw in the rent. We assume a 3% annual rent appreciation increase, which is extremely conservative, especially for where this property is located in Utah. We assume that the property is going to appreciate at 4%, again, well below the historical average for Utah, holding length of 20 years. And then we're going to assume at the end of 20 years, there's 6% cost to sell. So guys, before I go any further, just any comments around this calculator or how you look at these numbers?
Well, I would say I like to play with I'll run a couple of these for each transaction and do kind of a worst case, middle case, and a best case.
Oh, I love that.
Just to sort of stress test my thinking, if you will. So, I'll add more expenses, I'll add higher vacancy, and then do the opposite and run it several ways.
Yeah, I love that.
One thing I want to point out, just to add context, is having done this over 20 years and been on the front lines with a lot of clients, I would say once you get these tools at your disposal, they're extremely valuable and they help you make a swift decision. But
Yes.
People can also get stuck in extreme, paralysis by analysis and take deal after deal after deal and enter it in the calculator. And the feedback I get often from people who've been doing that for months is, well, nothing's a deal. I can't find a deal. I can't find something that's a good cash on cash return. And there's a lot of truth to that, because if you look at media online, a lot of people talk about how easy it is to get into real estate, get 100% financed, have somebody else pay for everything, but you get a great return, and that can go on and on.
The more you use these tools, Jake, the more you start to rely on them, and they help you over that paralysis by analysis, because you have a system, you have a process, and you realize, okay, that deal's okay. Like Drake said, I ran best case, worst case, and mid case. This one, isn't great. And then you'll find a deal that you'll go, wow, this is fantastic. But it's only the context of knowing what's a deal and what's not a deal is only really attained by going through this process and working through the numbers. And then you go, oh my gosh, this is it. This is the property. Yep. And that gives you the confidence and the certainty to actually pull the trigger.
Absolutely.
Yeah. All right, great. Thanks, guys. So back to the rental property calculator. Once you put in that basic information, you just simply hit calculate. And what this rental property calculator is going to do is it's going to basically give you perspective of what this investment is likely to look like over the long term. And I think that's one of the hardest things to understand on the front end of an investment. I mean, you can understand what the cash outlay is and what your cash flow is in month one or year one. And we can kind of do that with back of the napkin. But how do you do that for year 11 or year 20? And so in terms of getting the insight of what this would look like over 10 or 20 years, that's where I think this is super helpful for us. And again, you'll start to know, hey, this is a cash on cash return of 544% over 20 years. This is a home run, but I only knew that because I ran it on 15 properties before this, and this is far and away the best one. So just to kind of walk through here real quick, and Drake, you're really the expert on this calculator. Why don't you walk through this for us and guide us through it?
Sure. And the first thing that jumps out to me that I really like about this property from a just out of the gate perspective and from the perspective of avoiding risk is that the cash flow, the monthly cash flow starts out at positive $700 a month. So in my mind, when I'm looking to avoid risk, that's kind of the first place I start, because, if I've got other people paying the mortgage, that's really how I hedge a lot of risk.
Yep.
And that gives me wiggle room, that $700 a month. If I have a vacancy, if I have a repair, whatever, that allows me, I'm positive. So even if maybe I have one vacancy, I'm only coming up with a couple $100 a month rather than, a whole mortgage payment or something like that. So that's a first out of the gate, really big green flag for me.
Let me add just a little bit to that, Drake. Drake's so right. And listen to the language he's using. He's looked at things enough, and he's saying, well, it cash flows a little bit. And if there's a rainy day, I can afford some maintenance. And if I have one of 2 units vacant, I'm only going to have to supplement the payment this much. Translating that to like a lot of first-time investors I've seen, or perhaps what is taught at a lot of seminars is, well, your deal one should be an absolute home run. And if it doesn't cash flow X amount of dollars, then, go on to the next. And again, back to that paralysis by analysis, you can go a year or 2 or 3 trying to get in to your first investment, learning a decade later that the number one factor of your good return was just getting into it early and quick.
And letting time work for you.
Yeah. And what a great opportunity. I was just reading an article last week that was based on a book that was written about the history of interest rates. And what the article was saying was that the author went back and analyzed what was the going interest rate for a loan going back over 5,000 years. And what they surmised was the low interest rate period of 2000, 2001, the beginning of 2022 was the lowest long-term interest rates in 5,000 years. It's incredible. And so if you're trying to think about what's my entryway into an investment, well, the first thing that comes up for me is that if you have a home tied to a 2 or 3 or a 4% mortgage, that should likely be your first rental property. Turn that into a rental property, put a little bit down on another acquisition, and use the positive cash flow from the first property, your departing residence, to help offset the payment on the new property. And that can be a way to a kind of a gateway or an on-ramp to get into the investing world and leverage that low interest rate loan you may have on a property.
Absolutely. And the factor of time and amortization. This is often something I never see talked about when people are analyzing a transaction. But if you're 3 or 4 years into owning that primary residence and you want to switch it to a rental, even if you could get the same interest rate, remember you're so many months and years into your amortization. So now more of your monthly payment is going to buy down the principal debt than pay interest. Because time's always a big factor.
Great point. Yeah, it's like if you're going to put a tenant in a property, do you want more of that rent to go to pay the interest of your mortgage or the principal of your mortgage? Well, of course, the principal of your mortgage. Okay, then hold on to the rental property for a long time. Yeah. Great point, guys. Thank you. All right, Drake, walk us through this if you don't mind.
Sure. So, from top to bottom, like there's everything to like about this, right? You've got a 500% cash on cash return. I'd be interested to run it at a 1 year and see what the 1 year cash on cash return would be as well. But a 12% IRR. And so when I'm looking at percentages of return, you have to think about, or at least what I think about is like opportunity cost, right? So I'm always thinking, what's the best use of my money, right? And my sort of benchmark for opportunity cost is just the S&P 500 index, which is 10% a year. And so, or historically 10% a year. So I'm always debating with myself, like, okay, should I just put my money in an S&P index fund where I don't have to do anything or think about it or have any issues? Or do I want to deal with an investment property that is going to be more work and potentially more risk? But in this case, you're looking at a cash on cash return of 500%, an IRR almost of 12, and then a purchase cap rate of 10. I mean, not to mention any depreciation that you might be able to take or other tax benefits and amortization, all those things. It's pretty home run deal, like we've said.
Yeah. And I love that you're adding the often overlooked things or things that deal analytics often don't shove into a spreadsheet. And those are things like, all right, versus putting your money in an index fund, which is just here's the history and here's a return to expect. There can be a lot of other opportunities for perks in real estate to the deal. The tax advantages, does it appreciate more than you expected? Do rents go up more than expected? And as Josh mentioned, the input numbers, we were pretty conservative. And we add that X factor, time, the number one factor people overlook in real estate. We add that to the 10 or 20 year outlook, and your chances statistically go up that you're going to be the benefactor of one of these other opportunities to make money. I personally believe that's why real estate has been the tried and true, multiple centuries long best investment of many of the wealthy.
Can I add something to that, Jake?
Sure.
So, yeah, another cool thing about real estate when compared to stocks is you have the opportunity. It's much easier to get a deal on real estate, right? Because you're dealing with everyday people that have issues, right? Like they have a cash pinch and they have to sell their property quickly. They have a divorce and they need to, get out of it. Those things like that, you're never going to get a deal on Apple stock, right?
Yep.
Like real estate is easier to be mispriced. And that's why that you can, I think, get bigger returns with real estate over time than you're going to be able to get with the stock market, even though it's more work intensive.
Yeah.
Drake, that's exactly what's going on with this deal, right? You have a landlord who hasn't invested in the property to keep up the condition. It's now run away from them. And so they're willing to walk away from the headache at a discount because it hasn't been, well kept up and well managed. And now it needs a $250,000 renovation job. And it just seems beyond their competence level. Mm-hmm. And that creates the opportunity for the person who does have that competence level and can bring the capital into the deal, which you wouldn't see in most cases in like you said, in the stock market. So that's a really valuable point. One other thing that jumps out for me, and I think is worth explaining, guys, is what an IRR is. That's many times more of a commercial real estate expression, but IRR is an internal rate of return. And the reason why they calculate an IRR is because as a real estate investor, you get paid in multiple different streams. You get cash flow, you get the property appreciation, which is the value going up. You receive the benefit of the amortization, which is the loan going down. And this doesn't take into effect or into account any tax deductions. But as Drake mentioned, that's another way you get paid. And then the fifth way that you get paid, I call rent inflation. So this is the fifth way you get paid as a real estate investor. So with rent inflation, we would assume to see rents go up over long periods of time. And what the IRR is supposed to encompass is all of those things, excluding the depreciation from the tax deduction, but all of those things into an annualized rate of return over the prospective or anticipated hold period, which in this case is 20 years. Anything else you guys want to add to that?
Nope, you nailed it.
Cool.
I would say just to park on the rent inflation thing, I don't think people really wrap their heads around that as much as they maybe could, and it could really change people's mind or open people's eyes. For example, my first fourplex, when I bought it, it was pretty much a break even. The payment was $3,000 a month. The rents were $3,000 a month. Mm-hmm. Now, 20 years later, I've had the opportunity to refinance a couple times and ratchet that payment down a little bit, but the rents have more than doubled in 20 years, right? Yeah. So like that's where your delta comes, and that's where it really starts to make, even before you pay the mortgage off, that cash flow really starts to accelerate.
And Drake, this is really what this breakdown over time is trying to address. So do you want to kind of just walk us through this and show the illustration of what you were talking about there?
Sure. So like from the first column down on the left, you can see that's the rent inflation is captured in that annual income, right? Year one, you're starting at 48,000 and it's just going up slightly every year, but it's exponentially. And so 20 years, it pretty much doubles, right? Yeah. So that's the rule of 72. If your rate of return is 3%, I think you put the appreciation at, that means it's going to double in about 18 to 20 years.
Exactly.
So then the next column, you've got your mortgage, that expense stays the same. And in our case, we've ignored the possibility of being able to refinance, right? There's probably in that 20 years going to be a recession somewhere where rates dip, and you're going to have an opportunity to ratchet that mortgage down and stretch it back out and drop that mortgage expense. Could be thousands of dollars a year, which then you're just leveraging that delta between the mortgage and the annual income, or the mortgage and the expenses, which is your annual income.
Which, by the way, the probability of that happening right now in the time period that we're recording this in March of 2023 is extraordinarily high, because mortgage rates are near 30-year highs. And as such, maybe even going back 40 years now, and as such, there's a high probability that there's going to be an economic slowdown, which will trigger lower inflation, and that will trigger an opportunity to refinance. But there's no real way to factor that in other than just a wild ass guess. So we've left that out of the equation, but the probability of upside benefit there is extraordinarily high.
And let me add one thing to what Josh is saying and put it in the perspective of where the rubber meets the road, like on the street right now. I just had a client about 15 minutes before I logged on to this shoot me an email. They had been looking at upgrading homes from December to like February. And then a few weeks ago, they said, you know what? Interest rates are high and house pricing isn't coming down as much as we thought. We're just going to put some money into remodeling our current residence. Now, I could put that out on a spreadsheet, maybe project financially what might be the best decision long-term. But here's what I think a lot of even experts in the industry are underestimating right now. As the rate is higher and purchase prices in my market have come down maybe 17%, and I do believe that's kind of the bottom, it's bouncing there. And we've already shown signs of ticking pricing back up. The reason people were able to get 15, 16, 70% off this winter is because of the higher interest rate and people pumping the brakes. The moment rates do come down and more reasonable, we saw this in the few times they've dipped the last 6 weeks, house pricing goes immediately stable, if not starts increasing. So if you're really trying to time your best purchase opportunity, I believe it was this winter up to about now, before the cat gets out of the bag, so to speak. And here's the only reason why. Because you can buy at a deflated price and then refinance, as Josh and Drake just said, in the next 1, 2, what's the probability in the next 5 years? Extremely high. So then you locked in the lower price and get to the lower rate quick.
Yeah, and Jake, based on a lot of the bond mortgage-backed security traders and futurists that Drake and I listen to, I think the probability of being able to refinance in the next 6 months is extremely high. And in fact, as of the recording of this podcast, I'm in the process of refinancing 2 of my apartment buildings right now. And I said, let's get the appraisal done. Let's get the underwriting done. Let's get the cash flow analysis done. And then we're going to wait to lock in the interest rate. But there's going to be a moment where something in the economy happens because of the Federal Reserve increasing the Fed funds rate. Something's going to break. We're already seeing this. We've seen 5 banks go under in the last 30 days, maybe 45 days now. And as the economy starts to hit roadblocks and slow down, we're going to see mortgage rates dive. And I want to be at the front of that list. In other words, I want to have my deal already underwritten and approved and appraised so that I can lock and close, because once those rates drop, lots of buyers are going to come into the market, but also lots of people are going to rush to refinance. I want to get in front of that.
Yep, absolutely.
Awesome. Drake, walk us through the rest of this, because I love this over 20 years. What else are your takeaways over long periods of time of owning this property?
Yeah, I mean, I like that you added inflation adding to the expenses, because your taxes, water, insurance, all that stuff is going to go up over time.
Right.
Right. And so you can see the cash on cash return goes up over time. Of course, the equity. And then if you do sell
let's pause just real quick there, Drake, because this cash on cash return is pretty important, right? This says that, if somebody put $250,000 in cash into this deal, plus $8,000 for closing costs, so they're in this thing $258,000 in cash, that their net income as a rate of return each year, the first year is only 3.29%. And at first blush, we might go, well, wait, I can get 4.5% in a CD. Why would I invest my money at such a low cash on cash return? But again, what that doesn't consider is the amortization of the mortgage, the appreciation of the property. And then what this cash on cash return says is, hey, if you lock into a CD at 4.5% for 6 months, that's what you get. And then at the end of that period, you're going to probably go wherever inflation is headed. But with a mortgage or with a rent, we know that over long periods of time, that 3% cash on cash return in year 20 turned to a 15% cash on cash return.
Yeah, and a cash on cash return is kind of I feel like it's sort of a starting place, but I just want it to be a little bit positive, because I know all of those other 4 factors are going to be in play over time.
Yes.
But I do like that it doesn't need to be, 8% out of the gate, but it needs to be a little bit positive, just for that sort of security blanket, if you will.
Yeah.
Love that.
And let me add, I know we said this a bit ago, but enunciate what Drake is saying just for our listeners. Because a lot of times, a lot of first-time buyers or opportunists are listening to this kind of material, and a lot of other material I've heard, I feel like it makes it sound like this is extremely easy and you should expect certain metrics on returns. But what Drake is saying, hey, I've done this 1,000 times. I have my own investments. And as long as year 1 is net positive, maybe even 1%, he sees that as a positive thing. And I've found you do have to have that kind of mentality and mindset, or you're not going to pick up a deal.
Yes, you have to be able to
Totally
understand
agree.
the IRR, all the different ways you're paid by as a real estate investor. Yep.
Yeah, and then just moving on, you've built up to a $1.3 million in equity. So think about that. You put in 258, and 20 years later, you've got the opportunity. You've got $1.3 million added to your balance sheet and your net worth. And if you sell, that turns into 1.2. And it's probably worth at least sort of bringing up. It's a different podcast, but my strategy is buy 1031, 1031, 1031, die. Right? Like, I don't plan to ever sell any of these, because the tax benefits are also so good when you pass real estate onto your heirs, that I don't want to take that tax hit and take the big chunk out. I want to be living off of that annual income of $84,000 a year on the bottom left column in 20 years from now.
Well said, buddy. Really well said. So just kind of to summarize up this breakdown in this chart, over 20 years, cumulative cash on cash return, 544%, and your annualized internal rate of return, or you could also call it an all-encompassing rate of return of 11.85% over that 20-year period. Great. This tool is super helpful. If you haven't explored it, we recommend that you do. And it really will give you a wonderful education. If you scroll down in this calculator, it talks about, how they essentially come up with the analysis of these numbers. And it's very informative. So again, that's at that's at calculator.net, and then search for the rental property calculator. So Drake, or Jake, I should say, excuse me. This is useful for us in a residential 1 to 4 unit format, but you've created a little bit of a more sophisticated tool for commercial properties. So why don't you run us through the recent commercial analysis on the most recent property we bought?
You got it. As Josh just mentioned, guys, this is an actual transaction. This was consummated November of 2022, so just quite recently. And this is a medical dental office in St. George. In fact, those that are familiar with it have probably driven by this property many times. It's on your left-hand side, right after you pass the boulevard on I-15, and the Dixie Stadium's on your right. This building's on your left. We did have some deal experience in St. George. We've got another building down there we've had for a few years. And so, as mentioned on today's podcast, we did have some numbers and some context and some context to add to help us analyze this deal. So why might commercial be, other than obvious reasons, different from residential? Well, there's a few things. So I'm just going to give you a quick flyover on this sheet. We definitely don't have time to dive into all the details, but I can show you how we will run an analysis quick.
Hey, Jake, can you blow that up just a little bit?
Oh, yep, you got it.
Thank you.
It reverted back after we clicked off.
Yep. Yeah. Perfect.
How's that?
Thanks, buddy. Wonderful.
Okay. And before we dive into this, let me say one more thing about that timing. And we'll look at it when we get in here to IRR. I won't tell. Okay. So we will typically say, let's get the regular deal parameters. How big is the building? How many tenants are there? What are they paying? And summarize the income. And what's cool about a deal that's in escrow is that commercial brokers that are preparing these things for sale are often have more sophisticated financials than a residential deal. So if you have some good rapport, or if you got the right information, you can get a current rent roll, you can get last month's expenses. And so you're getting real deal material that's going to help you make the right decision. So these were actual numbers that we got in escrow, and we will just plug in total income minus total expenses. Now, to give you some gut check rules here, in commercial, if you take gross income, let's say that's $1 million a year, and you don't have a copy of the expenses from the seller, this happens a lot, guys, so tune in here, yet you're being pushed to make an offer because you're in a competitive situation and you don't have the time to dive into all the financials before you write an offer. A quick rule of thumb is about a third of gross income is the typical amount of expenses for a building. A newer building can be more like a quarter, so 25%, up to about 35% in commercial. So we can run a quick gut check analysis of what this might net after we determine how much debt we want to put on the property and what current interest rates are and how we're going to mortgage it. One other note on commercial, and Josh, this is obviously a whole nother podcast too, but commercial financing can be quite different from residential. And the amortization schedules in residential are almost always 30 years. And if it's not 30, it's usually 15. Those are most options 98% of people pick from. In commercial, that can be all over the place, and 20 years is more common than 30. Anything you want to add to that, Josh?
Like you said, that's probably a whole podcast to kind of go over the difference between residential and commercial financing. But no, I think you said that. I think you said that well.
Okay. So we'll get down to just these high-level metrics, and these are decisions or information that you can get really swiftly on a deal. What's it renting for? How much is it bringing in? let me take that to a yearly basis. What are the expenses? Then you've got net income, and then you can run calculations on how much debt you're going to take on. And right there, you're able to get to a cash flow percentage and what we call a debt service coverage ratio. This ratio is quite similar to Drake's last sheet, where he says year one, the cash on cash return is this, and the cash flow was only $700, but he's saying that's cash flow positive. A debt service coverage ratio is a ratio that says, is the income covering the mortgage?
Right.
And so people want to look for at least 1.0, because that means if it's bringing in $20,000 a month and the payment's $20,000 a month, you're a wash. And anything positive of 1.0 is the percentage at which the income is covering the debt. So when I've seen thousands of sheets and commercial brokers advertising how good a deal is, I would say it's pretty common to see debt service coverage ratios be between 1 and 1.5. All right. So
hey, Jacob, don't most commercial banks, I think they want to be around 1.25%. That's what they're underwriting to. Like they won't
kind of their
finance
minimum
you unless they're 1.25% or more.
Yep. And that's a really good point too, guys, because if you're analyzing a deal and it's not 1.25% or greater debt service coverage ratio, and the lender's saying, we can't do it. And let's say at this point in the transaction, your earnest money's hard and you're getting turned down from the lender, there is always the option to just get other partners as investors. That's easier in commercial, and bring more cash to the table, and that will better that debt service coverage ratio. So then it becomes pretty simple from there. We really just have to get the same projected deal analytics that Josh just plugged into the calculator for a residential deal. We have to say, all right, how much do we think rent is going to increase? So we're being conservative, putting in here 2% rent inflation. What do we think we'll see as far as appreciation goes on the market? We're putting in 6% at this deal. How much are the expenses going to increase annually? We're looking at 3% there. And then here's where spreadsheets can get very complicated, and it's what Josh already mentioned. It's actually calculating that IRR, that internal rate of return. Because to calculate an IRR, you have to project into the future and say, here's the date at which I would sell, and then run that backwards so you can get what's called a net present value of that money in today's dollars. Okay, so that's really what an IRR is telling you. Hey, if we sold this at the 10-year mark, what type of internal rate of return would we have averaged each year on our money for that entire 10 years? Okay, so when we ran this to give you an overall perspective of what we thought, and this was just in November, we thought, like we've thought on most transactions we're about to buy, we thought this is pretty skinny. We really like the deal. It's a great location. We know the building. We kind of knew the prior owners, which is how we got this off-market deal. We were confident in the numbers, but we also knew that if we have, remember, let's go back to the deal metrics. We've got 11 doctors and dentists in this building. If we had one vacancy, we would immediately go into negative cash flow. I'm only bringing that up to illustrate, number one, that we're real and showing you real deals. And that's how I like to learn deals in this market. But two, to illustrate that, as Drake mentioned, as long as it's cash flow positive, I'll take a look. Savvy investors say things like that because they're used to analyzing a lot of deals, as Josh mentioned, and getting that education under their belt, and then going, yeah, for the last decade, residential or commercial, guys, I'm here to tell you, a lot of deals at initial buy are tight, skinny, barely cash flow positive, and you got to add that X factor of time to start seeing those metrics improve. So let me show you, and I did this morning, Josh hasn't seen it, but in the 4 months that we've owned the building, that's a short period of time, we've already had a few rent raises, we're able to incentivize our largest tenant to stay with some minimal improvements and I think they signed a 5 or a 10 year with a pretty hefty rent increase. So 4 months ago, you're looking at projected. This is as of now, in 4 months, we're already up over 1% in our decade-long projected IRR. That may not seem much, but that's 1% year over year over year for 10 years.
Yeah, I think that's a really great point on this, Jake. When we initially looked at this deal, we couldn't figure out how it was going to work based on the current cash flow and the rate of interest that was available at the time and the purchase price. And so there's only a couple of variables that can change here. Either we need a lower purchase price, we need a lower mortgage rate, we need a larger down payment, or we need the income from the property. We need to be able to see how the income from the property would go up. And so as we started to work through those variables, as Jake said, we really loved the area. And I think this is how we're going to wrap this podcast is, kind of talking about headwinds versus tailwinds of different investments. But as we went through that, we said, man, the tailwinds, the things that are going for this particular investment are so good. We wanted to get granular around how we believed that the rents could go up. And as we dug into the leases, as we dug into the covenants on those leases expiring and what current leases would be, and a lot of those leases would increase based on the rate of inflation, which we know has been elevated, we basically forecasted out, all right, well, today, the price we're paying for it doesn't make sense. But in 6 months or 12 months, based on that income lever going up, then this thing starts to make a lot of sense. And then as we forecast over 10 years, we could really wrap our arms around it. So thanks for your help on that, Jake. I mean, there's no way I could have done that without you.
Oh yeah, man, no sweat. This is a passion of mine. I find it interesting and love to run the analytics, but there's also the street smarts part of a transaction, right? And here's probably one of my number one takeaways I've seen in real estate investing over the last decade, where sight unseen purchases are becoming quite common. And I've performed quite a few of them. And I don't think it's a bad idea. So I'm not saying don't do it. But what I've seen in sight unseen purchases is that good sales folk know how to highlight the numbers they want to show. Now, I'm not saying people are lying, but it's become commonplace to show a cash on cash return at X percentage, an IRR at this. And to me, they're all just hypothetical numbers until you have either actuals.
Yep.
And that's common, very common, that what we're seeing in marketing is not actual. In fact, it's okay. Most commercial brokers that's how things are marketed. They're marketed at a potential net operating income if they hit all of best market current conditions. So on sight unseen, you got to be quite careful that you know the numbers. And then what adds fuel to all that fire that we've really seen, not just the last few years, but for decades, is the speed at which people will transact, right? On the one hand, we have all these awesome tools and we can get information quickly. But on the other hand, that enables a lot of people all around the country to jump on a deal. Mm-hmm. And so you've got to be able to have these tools and a good advisor that can jump in and help you make sense of it. But sometimes you got to do as Josh mentioned, the back of the napkin pretty quick and get your hat in the ring, so to speak, in the form of an offer, and then work from there.
Yeah, well said, buddy. Well said. Okay, so again, the idea around this podcast episode was, 3 steps to help you avoid risk and maximize returns. So step number 1 is know your numbers and have a deal analyzer calculator. And as Jake just said, you've got to be able to do that quick, and you've got to be able to get an offer out the door, and then you can validate your thesis on that property as you go through due diligence and you get actuals and you say, hey, was my guesstimate accurate, or do I need to tweak anything? And that's exactly what happened on this deal, Jake. We ran the best that we could. We thought that it might make sense with the rents going up. We contracted it. Then we went down very granular into the leases and forecast out what those future leases would be to make the deal make sense. But we had to move quick to get there.
Yep.
So step two, so number one is a deal analysis calculator that you're fluent with and you know how to use really well, and you've done it enough to start to realize that's a deal, that's not a deal. Step number two, we want to make sure that we understand the demographics and the economics of the area, the county, the city, the area in which you're buying. Because if I run a cash flow analysis and an IRR and a property in Detroit, Michigan, last I checked, that was the lowest price to rent ratio city in the country. It may seem like that's a really profitable investment from a cash flow perspective because the price is low and the rents are reasonable. But what that doesn't take into account is what is the future economic prosperity of that particular area.
Right.
So I always want to see, are jobs going up or are jobs going down? What's happening with income? Is income going up or income going down? What's happening with demographics? Are people moving into the city or are they moving out of the city? If I can get a decent cash flow analysis, which is step one, and investment analysis, and I can see that the city is booming, then I know over the long term that I've probably undershot my initial pro forma. So let me just quickly share a very simple process to do this. So I just went in and I wrote job growth Utah, right? And I found two really important resources. I found Utah's unemployment rate summary from utah.gov, and then the Bureau of Labor Statistics. And then I found, some cool articles, right? Utah added over 40,000 jobs in 2022. So I've already pulled these up. So now I can go in and I can go, okay, Utah is booming. Jobs are absolutely coming to Utah. That is a very, very good sign. If this said Utah lost 40,000 jobs in 2022, I need to reformulate my investment thesis. Here's something else I found on the Department of Workforce Services. And again, this is very simple. This is 15 minutes worth of research. But let's take a look at the economic snapshot of Salt Lake County where this property exists. As of September of 2022, they were reporting already 37,467 new jobs in the county. 5% increase in jobs in Salt Lake County. State of Utah was up 4.4%, and the United States was up 3.7%. So I'm doing pretty dang good here compared to the United States. If I go over to unemployment, wages, and claims, I see that Salt Lake County only has a 2.4% unemployment rate as compared to the United States at a 3.5% unemployment rate. And if I just scroll down here a little bit, it goes in and it even breaks down. Fourth quarter moving averages in Salt Lake County grew 8.3% over 12 months. So what did I learn? I learned that Utah's adding a tremendous amount of jobs. We have a lower unemployment rate than the national average, and our income growth rate or our wage growth rate is faster than the rest of the country. That starts to tell me that that's a very safe place for me to put my capital because it's likely I'm going to be able to find a renter or a buyer.
Right.
Guys, what would you add?
Don't forget demographics too, right? So like just people moving into the state, which you can find that information pretty regularly. Like Utah, for example, the population is predicted to double by 2050. So not only are incomes going up, more jobs, there's more people coming as well. So that's just more demand for your product.
I would add too, though, that as mentioned, so many tools are at our disposal and our fingertips these days, and everyone has access, and there's so many benefits to that. At the same time, that empowers a lot more competition. And so, to have your ducks in a row, like Josh is on his refinances, to be already with the education, with the understanding, the markets you want to go into, the amount of money, cash on cash you can part with at the moment, you got to have this stuff lined up. Or you might fall brazen to getting into that deal that in the marketing looked great, but that's where you hear of horror story real estate mistakes. is marketing that looked great. People bought sight unseen on those numbers. And then the truth was far from that marketing.
Yep. Well said. And Drake, to your point, I Googled job growth Utah, but if I would have Googled population growth Utah, it would have kicked me back to the similar website. There's all these fantastic federal and state websites that has incredible data, and people don't go there very often. But it really, if you spend 30 minutes researching an area, you'll find very quickly, is this an area that is attracting jobs and young population? Or is this an area that is kind of withering away? And that's why I might be getting a better price, because the price is likely to go down, not up. Great point on the demographics. So lastly, guys, when we go through our investment thesis, and this is literally the process we go through when we're analyzing, should we buy a deal? Should we invest our hard-earned money into a property? Number one is the deal analysis, so we know what our rate of return is likely to be over the long term. Number two is the job, the population, and the wages in the area going up or down, right? That gives us the demographic trends we're looking for. And then number three is something that we learned from Warren Buffett. And I'll just read this so I don't mess it up. But Warren said that one of the lessons our management has learned, and unfortunately sometimes relearned, is the importance of being in businesses where tailwinds prevail rather than headwinds. And that's such a simple construct, right? A tailwind is something that is pushing your success forward, and a headwind is something that is pushing against your success in that investment. And in this instance, Warren's talking about businesses. I just translated it. We just translate it over to real estate investments. So Jake, let's talk a little bit about headwinds and tailwinds. And we only have 5 minutes, but let's talk about headwinds and tailwinds as it relates to medical office space in St. George, Utah. Literally, pull open a piece of paper, put a line down the middle, headwinds, tailwinds. And you go, okay, what's going against medical office space in St. George? Jake, go. Can you think of anything?
Not on the negatives. No. When I look at the rest of the country, let's hit positives first that couldn't put into a spreadsheet. Building is right on I-15, high traffic area, population growing, one of the fastest in the United States per capita and in migration growth, one of the lowest unemployments in the nation. It's a huge retirement community, which seems to spur medical and dental. Per capita, I think it's one of top 5 in the United States for retirees. Very little competing product.
Yes.
Really long time frame to build and construct new at a very expensive construction cost in today's inflated market. That's a big one, man. We could do a whole podcast on that, but checking that so you can see how competitive it might get if other big investors come into your market and build new.
Right.
And a lot of markets get crushed by that. How many malls have you heard of going out of business? And that's huge retail space because a new, better one pops up in a more dense spot of town. Really common.
Not to mention, the municipality is so busy in this particular area that to get a piece of land entitled, permitted, improvements, vertical construction, you're probably looking at, what would you say, Jake, 24 months at the fastest, 3 years to get something rolling. So if there's very low competition out there, the cost of new construction is skyrocketed, and it takes 2 to 3 years to bring new product in. And if you're looking at the numbers and go, it doesn't even make sense to build anything new. That tells you that you're going to have very little or less constrained future competition, i.e., our building is going to have lower vacancy rates. So all these things come together as you're doing the tailwinds, headwinds analysis, and what should shake out at the end is a thesis. Okay, my thesis is vacancy rates are at 1% for medical office space. They're going to stay that way. There's going to be very low new competition. The demographics of people that are in that area are older and are going to need medical attention. They're pretty wealthy. They do really well, and they can afford for those medical practices. And last time I checked, it was never going to be in vogue to do a lip surgery or a breast augmentation at a home office. Like they're going to need a place to go to do those procedures. And so we start to, as you start to go through that list, you start to come up with a thesis on that investment.
Yep. And on top of that, it'll make you more bullish on understanding deal metrics where, again, back to a competitive market, because we've really mainly had a competitive market for a good decade now. And I think because of speed of information, it's going to remain that way. Even when the market softened this winter, it's been competitive. And by that, I mean multiple offers. So if in a competitive situation, you can make that quick analysis, but also have kind of a street smart sense of these headwinds and tailwinds, then when a deal looks skinny, those headwinds determine whether you pull the trigger on that deal or not, because the financials may look really tight.
Yes. And one thing I would add to that, Jake, I would offer that it is infinitely more valuable to get this down on a piece of paper or your notepad and out of your head, because again, we're trying to get to a place where we're confident in making a decision and we're willing to trade money for that investment vehicle. And if all these things are just floating around in your head, it's really hard to have the clarity of, okay, here's the 22 tailwinds that are going to propel the investment forward. And here's the 6 headwinds that may hinder the investment. And as I see all those in paper, I feel like my headwinds far outweigh my tailwinds. But if you don't have it written, if it's in here, you'll have a harder time coming up with a confident decision.
Yeah.
Drake, anything you'd add to that?
No, I think that's a good construct for which to think through it, like to sort of distill it down. Protect yourself by having positive cash flow, have reserves, right? Run your numbers, and then allow your headwinds to propel the whole thing forward, right?
Really well said. Love that. Okay, last thing that I want to hit on here, because I know we're out of time. Thanks, guys. This has been really a blast for me, and I know super informative to our listeners. One of the things that challenges people is they can't find anything that cash flows in the areas around their home where they're comfortable. So I would just offer, one of the things that Drake and I put together a while ago was a remote real estate purchase plan. And we named it 10 steps for successful real estate investing. We actually created this for our internal teams to help them come to a decision and a good idea, whether it's a good idea or a bad idea to invest in a certain area. So if anybody wants to have a copy of this, this is basically a very, very detailed 10-step process to help you bring about confidence to invest in a real estate property that might not be in your backyard, that you might not be really comfortable with understanding the economy. So if that's something that you want, feel free to email me, josh@joshmettle.com. I'll send you that PDF. Guys, any closing thoughts before we end the podcast for the day?
They can send you that tool. I'm also consistently happy to look at deal analyzation and help people. There is obviously a fine line between how much free advice comes and then, are we working in a deal together? But I want to let people know that a lot of realtors, step one is, are you working with me or not? But when we step into investment and advice, we have partners in a lot of our buildings. I'm always happy to look at deal structure and go beyond kind of the typical realtor look and help you do a deal analysis. And then we go from there.
You're my favorite investment coach, Jake. So thanks for being so generous.
Thanks, man.
Drake, any closing thoughts?
I would just say if building a secure retirement is important to someone, they should take action and get themselves time in the market and don't try to time the market. So time in the market, not timing the market. Take action, get in, and let time be your friend instead of your enemy.
Can't think of a better way to end this podcast. Thanks, Jake. Sure. Thanks, Drake. Thanks, everybody.